This is Alan Bush with ADMIS. In the stock index futures, we are seeing prices a little bit better this morning as the Fed continues with their monthly purchases of $85 billion of treasuries and mortgage-backed securities, which for the most part finds its way into the stock market. However, we do have some concern with Bernanke testifying before a joint congressional committee tomorrow that there could be some hints as to whether the Fed possibly could scale back their quantitative easing program somewhat earlier than anticipated. Right now, the consensus view is that they may limit the QE in the fourth quarter. I'm thinking that there's a possibility that that could take place as early as in the third quarter. So we'll see how that plays out. But right now, stock index futures supported by Fed policy. Over in the foreign currencies, the dollar index, very strong again, and it has been strong now for the last couple of weeks. I believe that currency traders are looking at the possibility that the Fed may scale back QE. Of course, that would take short-term interest rates higher here in the U.S., which is bullish for the U.S. dollar. And I think that is the main reason. While we are seeing a very strong dollar in the last week or more, all other major foreign currencies have tended to come under pressure. In fact, it was just last Friday that the Japanese yen made a new low, in fact, about a 4.5-year low against the U.S. dollar. So from here, I would expect lower prices for the yen, lower prices for the Australian dollar as the global economy slows and commodity prices weaken. Of course, that hurts the export business of Australia. So that is one of the main reasons why we continue to be bearish on the Australian dollar. Credit markets caught between some very important cross currents. There's the bearish influence of the possibility of the Fed curtailing their QE. However, that is being somewhat offset by the influence of a weakening global economy. Longer term, I think it is the weakening global economic situation that will dominate, and I think that we will see a recovery in the credit futures market. In fact, I would not be surprised to see a move back up to near highs for the current move, although this may take several months. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.